This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode is Dave Ellison, portfolio manager of the Hennessy Large Cap Financial Fund and the Hennessy Small Cap Financial Fund. Dave has been recognized by Morningstar as the most tenured mutual fund portfolio manager in the financial services sector. We're going to discuss what is going on in the banking sector today and dig into one of the funds that David manages for Hennessy Funds. Dave, thanks for coming on Viewpoints by Hennessy.
Good to be here.
All right, Dave, last March on CNBC, you brought up an important question in an interview. Is it time to rethink the value of the business banking model? What do investors need to consider around allocating to the banking sector today?
Well, that's a big question. I think I try to keep things simple for myself as much as I can, because investing can be pretty hard. But I think you have to look at sort of four big trends in the industry, and obviously the four big ones are interest rates and the trends in interest rates, the trends in credit, up or down, good or bad, the trends in accounting rule changes, that there have been many over my long career, and then finally, whatever regulatory changes are coming or have come over the years and how they impact the industry. The two big ones, obviously, are interest rates and credit. And we have a cycle now, really in the last couple of years now, where rates have risen rapidly. We haven't had that in a long time. I started in the early 80s when rates were peaking. I didn't know it at the time, but the reality is we've had a 40-year bull market in rates. So we've had a banking industry that has had to deal with a decline in rates, and they've gotten very comfortable with that and very good at that. And now the rates are reversing upward, and the muscle memory is basically to deal with low rates and not with rising rates. And I think that's part of the problem, is that the banks are just not comfortable dealing with rising rates, and you're having the issues you have now. I think the trends in the industry now are such that the rise in rates may lead to a credit cycle, and that's the real big, kahunga. If you have a credit cycle, you're going to have real problems in the industry. And we haven't had a credit cycle in a long time either. And so we'll see how that plays out. But the industry has some challenges.
Clearly. So in a recent Yahoo Finance interview, you kind of touched on some of this. You said that during the great financial crisis, it was a credit mark-to-market one, and this is an interest rate mark-to-market one. And it's a lot different. But to use your words, it seems to be equally as punishing. Why do you think so many risk managers got this wrong?
Well, I think that, first of all, I think there are very few that have got it wrong, in a sense that, it's really created a problem for the company. I think people know some of the names that are out there, whether it be Silicon Valley or Signature Bank, and there's probably a few others to come, but most of them have managed through it. The problem is that you have a market now where it's working against the historical model of the industry. The historical model is to lend long and borrow short. And that's worked for many years, and it's worked for 1,000 years. Banking's been around for a long time. What we have now is, because what inflation has done and what the Fed appears to have needs to do, is they've inverted the curve. So now that model doesn't work, meaning that you borrow short at a higher rate than you lend long at. And so the model isn't working right now. And that's part of the reason why the earnings are generally declining in the industry. Margins are declining, and the stocks have not performed well the last couple of years.
It's a great way to pivot into this recent earnings season. We're recording this in April of 2023. What's your take on the earnings season so far?
Well, so far it's been pretty much in line with what everybody was thinking. And of course, they weren't thinking very positive thoughts going into the quarter, given what had happened over the quarter. I think the the outlook is going to be challenging the rest of the year as they deal with the yield curve and deal with the potential for credit to deteriorate even modestly, because credit's been very good for many years now. The loss rates have been historically low, and even if they were to double from here, they would still be below historical averages. And so you could easily see some pretty big increases in non-performers that would concern people. But rates are going to be a challenge for a while here, and that's in a sense the opportunity, meaning the opportunity in the space is ahead of us, not behind us, and we have to be patient and wait it out. So we'll see what happens.
So, in a recent interview on the TD Ameritrade Network, Dave, you suggested to trade vanilla stocks like traditional banks. Through that lens, what large names do you like today?
Well, I think the environment now is so uncertain. The problem is that we're talking today, and in 2 weeks the environment could be a lot different depending on what the Fed does or what it says, and even what some of the companies talk about after earnings. So it's a very fluid situation now. So what I'm focusing on is just buying the big companies, the JP Morgans and the Wells Fargos, and those companies that we know are going to be okay, that have a diversified business model, that aren't all sensitive to rates, aren't all sensitive to capital markets. They've got a mix of businesses. And the good news is that is probably okay. The bad news is that there's not a super amount of excitement there. I'm not giving anybody any significant insight or any real special super secret company to buy. It's sort of like, stay with the companies aren't going to blow up, and that's an investment strategy. I'm not sure if it's a strategy that really generates excess returns. It's basically trying to lose less than the overall sector as a whole.
Let's pivot and dig into the Hennessy Small Cap Financial Fund. Dave, you've been managing this fund for 26 years. I don't know that I've ever interviewed a manager who's been managing a particular strategy for that long. And these are incredibly interesting times for this space. So let's start at a high level. What is the portfolio construction process for the fund? And then we'll go deeper.
Well, historically, it's been to focus on valuation, focus on earning sustainability. Again, there's about 4,500 banks in the country. The small cap space that's public and really readily tradable is about 500 or 600. So, I'm looking at 300-400 banks, and so your sample size is quite large, which is fun because you have a lot of compare and contrast. But basically, you're focused on valuation. You're focused on earning sustainability. It's a fairly simple model. But the opportunity is in the cycle for this space, and more so in the smaller names. You need to have a financial cycle. You need to have, rates go up, rates go down, credit get good, credit get bad. The economy, boom and bust, although not maybe as severe as that. And what's happened the last number of years, up until more recently, is that the Fed has not allowed that cycle to play out. And so now my sense is that we may get a nice cycle here where we have a rise in rates, we have a rise in non-performers, the stocks reflect those negative cycles, and then we come out of it. So you make your money here when you go fundamentally from ugly to okay to good to great, fundamentally. And right now, the fundamentals are okay. And to be completely honest, I'm hoping that they move toward the ugly side and not to the good side, so that the stocks reflect that. And we have an opportunity to buy, high quality banks at lower valuations, and then play that recovery as the economy recovers, credit recovers, and the yield curve resumes a more normal shape.
So when you think about risk management in a strategy like this, how do you approach the sector as a whole? And then what is a typical trigger to remove a name from the portfolio?
Well, the trigger is typically valuation, and that's been historically, it's always been trying to upgrade the portfolio on valuation. So if a stock trades at north of 2 times book, and I can buy something near book value that has a similar management team, a similar paying attention to the details of what's happening, you make that trade. And so it's fairly simple. There isn't a lot of super secret stuff here. These companies are all generally in the same business. They're all lending into markets that are pretty homogeneous around the country. They're competing on deposits that have a national price. There may be some regional differences, but it's not that much like it used to be, 20, 30, 40 years ago. So the idea is you're playing on valuation and management. And that's a critical component that has been important for many years. So that's generally what I look at. I keep it simple. From a big macro perspective, that's fun stuff to talk about, but it doesn't necessarily move the portfolio one way or the other.
And when you think about the portfolio today, what are some of the names that you find very compelling?
Well, again, it's a tough environment now. Compelling's a hard. We don't use compelling that much when I talk to other people in the business, because it's all about how do we not lose more money than we've already lost this year in the portfolio, to be completely honest. So we're trying to protect. So we're basically buying the highest quality names we can find from a management perspective, and just holding on and hoping that the yield curve settles down and the credit cycle doesn't get bad. I think the risk here the next 6 to 9 months is that the credit cycle presents itself as being a problem, and the stocks will go down. There's no question in my mind the stocks will go down, and so, but that's the opportunity. So I think that talk to me in 6 or 9 months and we'll see what's going on.
Well, we'll definitely circle back up on that question in 6 to 9 months. And in fact, let's wrap with this question. And you've already answered some of it, but what is your outlook for the rest of 2023 for the banking sector?
Well, I think again, the bulk of the companies will be okay. The question is, what is the yield curve going to do? We know the yield curve is creating problems for margins. We know credit is potentially a problem. And those are the two things that matter. And I think right now, the macro backdrop is against us, and it could be that way for a while. And you just got to be patient and wait it out. And so that's what I'm doing. And in the meantime, I'm holding a little more cash than I would otherwise, and trying to, protect the downside by buying, hopefully, the companies that are paying attention to what's going on and aren't going to get caught off sides either on rates or credit.
Well, Dave, that's a very pragmatic and sobering look at the banking sector. I hope you come back on Viewpoints sometime here soon, because things seem to be changing pretty rapidly in the space. Viewers and listeners, if you'd like to learn more about the Hennessy Small Cap Financial Fund or any of the funds from Hennessy Funds, please visit HennessyFunds.com. That is HennessyFunds.com. Thanks, Dave.
You're welcome. Good to be here.